Good day and welcome to Triple A Professional Institute. I'll be running you through financial accounting, financial reporting, as well as corporate reporting. If you are not subscribed to this video, please do so. It's important that you do so to keep us also serving you better. Today, we'll be looking at the overview of accounting, the conceptual and the regulatory framework. This class now we'll be looking at the overview of accounting, and the next class we'll look at the regulatory and the conceptual framework. Every business exists, and then to make profit. Making profit, you need an accountant to help you have. There are exchange of money, exchange of substance, exchange of value. You need an accountant to help you out. So quickly, definition of accounting as it were. Accounting is the systematic way of identifying, recording, classifying, summarizing, preparing, presenting, financial information for users, as it were. I call it systemic because it must really be systemic, and then you must be able to gather the required information. That's what we call the record keeping. Then we have after you have gathered the record, you must be able to classify them into appropriate headings and ledgers. Then from there, that is where you bring out the information you need to prepare the financial statement for the users. So that is that for that. And so we have difference between bookkeeping and accounting. Bookkeeping, as it were, is all about gathering all of the records, putting the records in place. That's that for bookkeeping. The while accounting will need the record that a bookkeeper kept in order to produce what we call a financial report or a financial statement as it was. So that's just the major differences between bookkeeping and accounting. You might be asked what is the differences, and that's why I'm giving this explanation. Bookkeeping is all about keeping the records, whereas accounting is all about making use of the records that have been kept. Now, the users of and the information need of accounting information. Every report that an accountant prepare is known as financial information, and there are users of this financial information. So we have the users as well as their needs in usage. Now we have different kind of users. We can group them into primary and then secondary users. The primary users are classified as the owners of the business, and then the secondary users, they are the external users that are not maybe in the business as it were. Pause. So users, like I said, can be classified into the internal and the external users. Internal users, basically, they are the shareholders, the managers in the business. Shareholders information need are, basically to know the performance and the financial position of their entity. Owners of the business, like I said, we have the sole proprietorship business, we have partnership business, we have limited liability companies that are also in business. All of these put together, they also have needs. They need to know what is the content of the financial information that have been provided, and the essence is to know the So that, like I was saying, those users can be categorized into internal and external. Then under the internal, you have the shareholders and management. That's it. Then these ones, you need the financial information, and so that they can as well know the performance of their business. As well know the financial position, that is their net assets as at the period when that information is provided. Okay, and so like I said, that's what they use it for. Shareholders, the management, that's 1 and 2 now. Carry 1 and 2 here. Management, they are the managers of the business, so you need to know what they have even done, and then they need to know what is the position of the assets that have been committed into their hands. That's that for that. So the external users now, we have the lenders. The lenders, the need is for them to know the gearing level or the debt capability uh, of the entity, for them to know if they can see secure loans and the likes. So that's that for the lender. So you also have the let's say suppliers now. Suppliers need to know. Suppliers, they are also part of the users of financial information provided by accountant. And so suppliers, they need to know if the entity will be able to pay off their debts, as it were. So here, the review will be on the payables of the company or the entity or the business, so to say. So that is that for the suppliers. And then after the suppliers, we have even government and its agencies. Government need to know the level of compliance with extant laws. You know, for instance, Company and Allied Matter Act prescribe that every company must present an annual financial report. So they need to know the level of compliance. And then when it comes to tax authority for the government, you need to know if the business is actually paying what we call income taxes. So that is the needs, as it were. Then you have others like the employees. Employees need to know if they will continue to receive their salaries. It's important for them to know if the entity will be able to continue to pay their salaries. Then continue to pay salaries. That's that for the employees. And then we have other users, which also include the creditors. The creditors, all of these ones, they also need to know the creditworthiness of an entity. So you have various users, external users, even members of the public. Public need to know the going concern, that is, if the company will continue to be in existence. Then you also have even investors. Investors need to make decision as to their investment in the entity. Maybe to invest rather in the company. That is okay. So that is that for that. Like I said, so those are the users of a financial statement. They are still more than these, but basically we can just mirror it down to these ones: internal users, shareholders, managers; external user, lenders, suppliers, government and its agencies, employees, creditors, members of public, investors, and their needs are well stated there. So quickly, let's go to the other one, which is the roles of the accountant. The roles of the accountant. And the importance is if we want to mirror it, and we will say why do we need an accountant in a business. Number one, for financial reporting. For financial reporting, an accountant in the business to be able to enhances your report, as it were. You know, the quality of your report will also determine the quality of how well you are able to render account of stewardship. So you need an accountant for financial reporting. That's number one. Number two, you need an accountant for compliance purposes. For compliance purposes, an accountant will help you to comply to extant laws and regulations, as well as standards that guide the preparation and the presentation of a financial statement. Also, why do you need an accountant or roles of an accountant? They help to trigger what we call internal control. They put internal control in place. You know, they said where there is no control, abuse are inevitable within the business. There will be a lot of leakages. So you need an accountant in order to put controls in place. That's that for that. Equally, why do you need an accountant? What is the role of an accountant? They do what we call analysis of financial information. They do analysis of financial information, information, as it were. And what do? They analyze every financial information and put them in perspective of quality decision making. You know, if there are no analyses, you may not be able to make adequate and informed decision. That's why you need an accountant, or that's the roles of an accountant. And the next one will be preparation of your taxes. Preparation of taxes. You need an accountant to help you prepare your taxes. If you are not tax compliant, government may come and shut down your businesses, and that's why you know an accountant will help you prepare taxes as it were, and help you to even file them and get the necessary certification. So that is that for that. Quickly, let's look at the accounting processes. Accounting processes, and when we talk about accounting processes, what are the processes that are involved in it? Let's look at the accounting processes. You know, the processes, what we're talking about is you being able to do proper renditions when it comes to accounting as it were. What we are just doing is to build up the basics. More or less, this is an overview of what it's all about. Accounting as it were is for, you know, you being able to prepare adequate financial. So the processes begins with from the definition of items on the financial statement, and to definition, to recognition, to measurement, to presentation and disclosure. Don't mind this my marker, just please manage with it. Presentation and disclosure. So, definition talks about you know, giving the items the definition that is needed. And as an accountant, you must know the definition of every item that is on the financial statement. They are all classified under the element of financial statement. When we get to conceptual framework, we build more on that element of financial statement. So you have the assets, you have liability, you have equity, you have expense, and then you have income. So all of these, they have their definition. So each of the items of financial system must also align with every of these elements of financial. When we get to conceptual framework, like I said, we'll look at that. Then the recognition. The recognition is all about how it should be classified on the financial statement. It's important as an accountant that you must know how each of these items, or all the items, maybe for instance your expenses, where they fall into, your liability, you should know where they fall into, your equity, all those items that are made of such, all those components that make up such of this classification, you should be able to know that. That's under the recognition. Then we have the measurement. Measurement talks about the calculation, how you are to calculate all of each of these items and then put them into figures. You know, accounting is all about figures. Although we have what we call notes to the account, and we talk about how you comply with the policies and the processes. And then you have the presentation and the disclosure. This is also very important as an accountant. So these are the processes. We'll build more on that when we'll get to our subsequent classes. So very quickly, let's look at the accounting basis and then the concept. The accounting basis and the concept. So when we talk about accounting basis and the concept, we are looking at the guidelines, what you are to follow as an accountant when you are preparing your financial statement of your financial report, as it were. And so we have what we call three basic accounting bases. So we have what we call the accrual basis. This accrual basis talks about recognition of events or circumstances within a period of time as at when that event occurred. Take for instance, I went to recognize revenue. Accrual is talking about the historical background, historical cost, as it were. Now, for you to recognize revenue, you need to look at when the transaction actually occurred. Not necessarily when you receive cash. The term accrual means it has happened before you receive the cash. So what we are saying is this: you recognize an item on the financial statement, you can use the accrual basis. Recognize that item when the transaction for that item occurred. That's number one. Number two, we have the cash basis. The cash basis is talking about the fact that you recognize an item when cash is received. When cash is received. When cash is received. The first one is talking about recognizing the item when the transaction occurred. When transaction occurred. The second one is talking about when cash is received. And the third one is the breakup basis. The breakup basis. This one is looking at the fact that the company will be in existence in longevity, that's for into perpetuity, as it were. While the breakup is looking at the fact that the company, maybe when they break up, how do you recognize items in the financial statement?